Okay, everybody, welcome to Investing with IBD, sponsored by Vantage Point. Now, it's Wednesday, June 23rd, 2021, and I'm your host, Justin Nielsen. And on today's show, we are welcoming Matt Caruso back to the show. Matt was on earlier in the year, back in March. So if you want to take a look at that podcast, it's a good idea to refresh your memory on what Matt Caruso is all about. He's also the president of Caruso Investments and starting a new product called Caruso Insights. And we'll talk a little bit about that. But welcome back to the show, Matt.
Thanks so much for having me. It's a pleasure to be back, Justin.
Absolutely. So a few things that we're going to get into today. We're always going to start with the markets, dive into that a little bit, what's going on with the markets currently. We're going to talk about how this last year or so has been a little bit of a microcosm for investing lessons, and also in the second segment, we'll talk a little bit about these numbers behind the numbers and the shades of gray. So Matt has a lot of insights there. And of course, as always, we're going to end with a few stock ideas from Matt. So again, thanks for being here, Matt. Let's go ahead and get right into it. We've got, mild distribution relatively. It's not getting too bad. I mean, we did have a lot of distribution days kind of start piling up there, but we are still in an uptrend. We've gotten to new high territory. And even though we've, kind of closed well off the highs today, it was a pretty tight spread between the highs and lows today, and we are still in that new high ground, and more importantly, we're above that 14,000 level. So what's your take on the market right now, Matt?
Absolutely. So I see this kind of reminds me back in 2019, late in the year, there was the whole trade war worries, and we kind of went sideways for a few months. And from that point, we kind of walked into new highs and started a nice stair step higher right into the COVID situation. And that kind of, I get a real strong sense whenever I've seen these, several month sideways consolidations in the market without any, severe news coming up or a Federal Reserve tightening, they tend to resolve to the upside. And I think you're starting to get signs of that, because if you look at the growth stocks, which typically signal some risk on, those have really been leading in the past week. So I think the Federal Reserve last week kind of changed the dynamics of the internals of the market, and which I think is great for the NASDAQ and especially great for growth-oriented investors.
Yeah, and I think, to your point, a lot of people, especially when they're first starting out, can get very disheartened. I mean, this has not been an easy market if you've been trying to play things the last couple months. If you've been in the right areas, energy and materials and things like that, not our typical growth, but more of the cyclical, you may have been doing fine. But if you've been in growth, you've been getting smacked around a little bit the last couple months.
I think this whole past year, this is the perfect study year for anybody to go back and review, because within the span of 12 or 14, 15 months, we've seen almost everything. You've seen a crash, you've seen a dramatic rally, you've seen internal rotations. Everything seems to be happening at super speed. So even last year, off of the COVID bottom, you saw stocks usually that would show the returns after several months. Several years, they were doing those returns in several months. And I know in other cycles that I've traded, typically growth will lead for a good amount of time, probably a year or two, and then energy and cyclicals will take over. And this whole past year has been, wham, big rotation into growth off the bottom, then rotation into cyclicals, and growth in reality went into a bear market after February of this year. It's right. Not really highlighted on the indexes, but if that's your niche market that you're focused on, if you weren't prepared for that second bear market that's not shown in the indices, you could have gotten very hurt, especially given the size of the moves. So this past year, just the rotations have been so violent, and it's just the perfect microcosm for anyone who wants to really get a quick education on how the market, transitions from segment to segment in a market cycle.
Yeah, I think one of the things that, and this is something we've talked about on the show before, one of the things that was really kind of masking the weakness, it was really a lot of those COVID plays, a lot of those high growth names that were getting pretty decimated, well below their 200-day moving average lines. But what was kind of making the NASDAQ not look quite as bad was the whole idea of some of the big cap names like Google and Microsoft right. and Amazon. Those were kind of propping up. I mean, they have such a huge weight in the index, and it was almost like masking some of that weakness that was underneath. So sure, if you were in those, you were maybe not noticing, but if you were in the old names or trying to play those on weakness, buying on dips, I mean, that was a good way to get destroyed.
Oh, absolutely. And you have to always stay tuned into the market, because that leadership starts to change as one sector is topping. I mean, you have nice profits that you're sitting on. You're you're looking at an oil stock, which is not really too exciting when you're in these technology stocks changing the world, but that transition starts to happen slowly as, funds or large investors start to slowly scale out of these growth winners and starting to buy cyclicals. And so, the marketplace is somewhere where you have to always be on your toes, always be, be aware of where the money is flowing, because sometimes these transitions can be just brutally quick, like we've seen.
To that end, again, a lot of these cyclicals were really helping the S&P 500 and the Dow Jones Industrial Average. Now, both of those, are not showing quite as much strength, but the Dow Jones Industrial Average, that's now below its 50-day moving average line. Now, granted, it didn't really have much to fall. It's been a very, steady move, and it's not like that was it never got quite extended above that 50-day moving average line, so it didn't have much to fall. But are you seeing weakness here that is concerning, or is it just, hey, it's back to NASDAQ, there's nothing to see here?
I think for investors, who usually follow along with Investors Business Daily and are growth oriented, I think it's almost a good sign because it shows that rotation back into NASDAQ stocks. And in reality, the way I keep a very close attention to when the Federal Reserve speaks, to me, that in my point of view, that's kind of the earnings report for the market. So sometimes a good earnings report can, jolt a stock higher and start a new trend, or jolt a stock lower and end the trend. I find typically the Fed, not always for the market as a whole, but also the internal rotation. So I think it's pretty clear. You can see last week, the Fed was still extremely dovish, and, they're talking about rates 2 years out, which is quite a ways away. And so the Dow kind of backed off a bit, but you saw some growth really catch fire in the past week or so, which has been nice to see, from our perspective. And, typically it's hard to get too negative when there isn't a negative catalyst out there, or when the Federal Reserve is not tightening already. I think the old rule used to be 3-step stumble. So typically once the Federal Reserve, tightens 3 times, we're talking about tightening only 2 years from now. So before we get to that 3 steps, I think it's hard to get too negative in a market like this, especially when you're sitting near highs. Even, there may be some rotations, but you really want to just focus on where the money is going, and you want to be positioned properly in those sectors. Because in my view, I think, the Federal Reserve is really the author of bull markets and bear markets. Individual stocks have their own growth trajectories, but as a market as a whole, I think the Federal Reserve is just such a key, organization you have to keep an eye on. So the fact that, Jay Powell spoke and he's saying, look, everything is going to continue as it's going. We're not tapering. We're pushing, hikes far into the future. I think that's a great backdrop for the market, especially a NASDAQ coming out of almost a 5-month consolidation.
Now, the way that financials kind of really, moved, it was really interesting how the reaction was so dramatic for financials. And I'm going to go ahead and pull up XLF on MarketSmith right now, just to kind of show what we're talking about for those that are watching the video. So you had the move by the Fed, the Fed talk right in here, and then the very next day, it looked like financials were getting some strength, but the very next day it was kind of this feeling of whoosh, where the financials were down very, very strong. You had energy, XLE, just as an example, was down pretty strong, but energy and a lot of the oil stocks came back very strongly. Does that suggest to you anything about like a little bit of a mixture with oil and growth? And anything to say on that?
I think oil's in a special place right now because, given the whole COVID situation, I think there's short-term supply constraints. So sometimes the commodity itself is in its own universe, is the way I would look at it. So I think oil specifically is benefiting from that, and that's still pushing in that space. But in general, I think like the XLF chart you brought up is a lot more concerning. The way you broke through that 50 with big volume, and this kind of move up here is a very weak reaction higher after that drop. So for, as an index as a whole for the Dow or the S&P, it's not terribly concerning. But if you're heavily invested in this, financial sector, would be a little bit more concerning for me. You may not have huge losses because the Fed is so accommodative, but you may sit out, potential profits in an up leg.
Right. Okay. So now let's get back to this idea that you were talking about with the last couple, I guess, year or so being a microcosm. I remember that a lot of times we were talking about, hey, bull markets, they last about, a year and a half, 2.5 years. Your bear markets are about 9 months. And you were kind of talking about how all of this got squished together. So what are some of the big lessons that you think? Because a lot of people, I mean, let's face it, a lot of people started out, they were, kind of at home, got interested in investing. They started out during this time. What lessons do you think people should be pulling from it, or how can they capitalize on this kind of moment in time that they were a part of to understand, what's, I guess, different about that market, and maybe what's the same, just maybe on a different time frame?
So I remember when I first started, studying a lot about the market, it was almost that 4-year cycle they would talk about. It was like clockwork. You could look back at different market environments and see every 4 years you had a market bottom. They would call it the presidential cycle or whatnot. But that's the thing with the marketplace. You can never be too rigid, because the market does change. It does alter itself. So if you're sitting there with a clock saying that, okay, we have to go another 2 years, but some other force kicks in, you have to be able to adapt to that. So I think one of the major lessons that you should learn is if something went wrong in your investment approach in the past year, you have a problem with your investment approach or lack of certain rules. So you need those buying rules. You need those hold rules. Anyone who bought a winner at the beginning of last year and let it go after 2 weeks, missed out on a massive opportunity. And people sitting with these huge profits, into January, February this year and didn't take those profits only to see them evaporate over the next couple of months. You also need those sell rules. So I think this past year is the best testing grounds for the system that you're using. If you're new, sit down and write out every mistake that you made and what can you improve. And even if you're a veteran, this even, tested veterans, anyone who was a little sleepy or a little slow to adapt or move, you really pay the price for that. So it was a great time. Whatever section of the past year you messed up, realize there's something that you can make better in your approach, whether you missed a rotation, you missed your holding periods, you missed your sell rules. That's what I do. I've been spending so much time. I made this year the year of relative strength for me. So I could really focus to see where the money is going. I saw that there was such power behind that last year. And every year I like to kind of designate an area I focus on. So this past year, I think is just the best period to study.
Okay, well, you know what? We're going to get back after the break into that whole idea of what you learned from your own post-analysis, some of the numbers and the numbers behind the numbers and those shades of gray. So stay tuned and we'll be right back. Do you want to conquer market volatility? We can help you protect your hard-earned capital. Visit www.freestockcoaching.com and find out how Vantage Point's AI technology can forecast stock market trends up to 72 hours in advance with incredible accuracy. Vantage Point's patented technology analyzes huge quantities of global data in seconds, so you can finally stop guessing what's going to happen next. Check out www.freestockcoaching.com and experience Vantage Point for free. Learn how successful traders generate their wealth. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to Investing with IBD podcast, sponsored by Vantage Point. I'm Justin Nielsen, your host, and my guest this week is Matt Caruso of Caruso Investments. So, Matt, before the break, we were talking a little bit about this whole idea of post-analysis. What were some of the takeaways that you came away with from your post-analysis of this last year?
So one of the main takeaways that I had from my post-analysis was just the importance of relative strength. But you want to go beyond the number that we see in Investor Business Daily. It's great. I use it in all of my scans. It's a go-to that I always watch. But there's certain situations, like last year was a key situation where if you didn't understand how that number was built, you wouldn't have noticed that there was something wrong with the criteria. By that, I mean, the RS rating looks at stock performance over the past 12 months. So you could have had some stocks that, after the COVID bottom rally 400 or 500%, and they have a 99 rating. But then as that stock is correcting maybe significantly and losing its leadership position, you still have that 99 or 98 rating. I mean, some stocks like APPS or Zoom, they still have some really strong RS ratings, but they've really taken quite a hit. So this, has fallen from from 102 down to $53, and we're still sporting a 97. So if you're just scanning, this comes up as a leader, but in reality, with the NASDAQ at its highs and this still sitting a significant amount below its highs, it's not really in the leadership position. So one of the key takeaways that I had was you want to also look at how is a stock reacting directly to the index. So rather than just rely on the number, which is one of, a key component, But in this past year, because of these dramatic moves, it could be a little bit deceiving. So what I like to do is also look at, one low on the S&P 500, compare it to a past low, and make sure the stock is also acting as strong or stronger than the S&P, regardless of what that number is. So for example, at the end of last year, some, rotations into these electric vehicle stocks, I have to admit, I was never into Tesla. I was never a huge fan of the car. And it's kind of one of those, some people love it, some people don't.
Right.
I wasn't.
It's either one or the other. There's not usually anything in between.
I like muscle cars and I like engine noise. So it never appealed to me. But you know what? The strength coming into that sector at the end of last year, I mean, that was a big missed opportunity. And so if I would have been, watching a little bit closer, I could have caught some of those great gains. So sometimes your post analysis is not only, where did you lose money, but, how did you miss out on a great opportunity? So I think going beyond that number and really looking at the price action relative to the index is just such a key component as well.
Yeah, it's funny that you mentioned that, because there's so many of the rules behind CanSlim that were developed because of that post analysis that our founder, William O'Neill, did. And a lot of times it was a missed opportunity. The one that jumps to mind is Certainteed, where he messed that up. And so he came up with the 8-week hold rule, and then he used that on Syntex in 1964 or 1963, and that was kind of what put him in business. But I want to get back to another point that you made here, because another interesting thing that I did learn from Bill O'Neill in the time that I worked from him was coming out of that 2008 financial crisis bear market. That point that you were making about how you've got the stocks and you compare what they're doing versus the S&P 500, because as I was looking at Bill O'Neill and what he was buying, and I'm going to go ahead and pull up a chart here, and maybe you and I can walk through this together, because I think it's a really important point here. I'm going to pull up Apple. If you look at what was going on here with Apple, and this is back in 2009, there were these moments where you had this low in January, and then you had a low that wasn't quite as low. So it instead of going down to 78.20, it came down to 82.33. So it held up a little bit better in March. And you contrast that with what the S&P 500 did. Look at the difference there. You have the January low in the S&P 500, much lower in that March low for the S&P 500. So that's such a great point, Matt.
And that's a key indicator approach that I like to look at my stocks at now is comparing lows like that. If the market's making a lower low and your stock is not, even if the number is for, let's say 85, it's not, sporting that 95 or 99, that's the market telling you that in this correction, they don't want to sell the stock. I mean, what's more powerful than someone not selling a stock as the market is coming off?
Right.
And the other way I like to look at it too, because sometimes, like for example, with COVID last year and that crash, the stocks will fall with the market rather dramatically. But another way to look at relative strength is if the market only recovers halfway of its correction, but this stock gets right back to the prior highs, I mean, that's a form of extreme relative strength for me as well. And that's how I found a lot of the leaders last year, such as, Livongo and Fastly and Peloton, although they had some pretty significant drops in the crisis and the crash, they were right back to their February highs or January highs relatively quickly. So either not falling or bouncing back quicker than the market are two really key ways that I like to look at my stocks versus the market.
Yeah, a couple of weeks ago, we're making the analogy of a toolbox, and I feel like what you're dealing with here is some specialty tools. You can think of your relative strength as your hammer, but if you're going to use some of these nuances that you're talking about, then you've got the difference between a claw hammer, a ball peen hammer, a mallet. You're really using the right tool for the job if you can kind of get into some of these nuances that you're talking about. And what about the relative strength line itself? Is that something that you pay a lot of attention to as well?
So there's one aspect of the line that always kind of bothered me a little bit is it's just pretty much the price divided by the index itself. So
right.
The issue I have with that in my studies was that these stocks tend to be more volatile than the market anyways. They usually have a beta greater than 1. So for example, if the S&P goes up 1, typically these tech stocks will go up 1.5 or 2. So whenever the market is kind of moving upwards, this RS line will, if the stock is climbing, will always point to new highs. But the way I like to kind of dig a little bit deeper, and I kind of built a proprietary way myself where, I compare the stock relative to its beta to the S&P. So I don't know, it's starting to get a little bit complex, but by that,
I was told there would be no math.
If, for example, if your stock typically goes up twice the market, well, if the stock today is up only 1.5 times the market, sure, it's advancing more than the market, but it's still advancing slower than it should be.
Mhm.
So I guess the best, way to look at that is, a pitcher, if a fastball is typically 99 miles an hour, they can throw an 85, which is fast for you and I if we're
Oh
throwing a
yeah.
fastball. But for that, major league pitcher, it's slower than he should be throwing. So I don't know. It's kind of again another nuance, kind of
Mhm.
a really specific part of the tool. But it's another way I try and dig really deep into relative strength and to compare, that stock specific reaction to the market.
Well, I guess to a certain degree, it's almost like you're getting that relative strength, but rather than relative to the market, relative to itself versus the market in a way.
It's that
with the
one
beta.
step further. So if you
Mhm.
really want to dig deep, so again, it's the year of relative strength for me in my studies. So I've dug as deep as I could, and these are some of the nuances that have come up to me in my studies.
Mhm. So, you know what? This is something that's also very important. I think there's so much learning that can be done when you do some of these studies. So, not to get too far off track, but how do you kind of approach your studies? And when you say, "Hey, you know what? I want to do a deeper dive here," what do you start with? Are there any tools that you might suggest for our audience that they could use to kind of do their own studies?
So there's two tools I really like to use. One is MarketSmith, just fantastic. It has all the data you would need in there. Another one I use is TradingView. I'm not really a great coder. I can kind of do the basics, but they have a function that I like where you can kind of set a condition, simple, it's very simple logical conditions, if this, then that. And
Yeah.
it'll highlight on the chart, different colors. So you can visually see very quickly, what the outcomes are of the conclusions you're trying to build. So I kind of use that as a shortcut for myself to kind of speed up. If I have an idea and I think it's a bullish setup, but I quickly plot it on the chart and I say, whoa, this is not at all what I was thinking would come up, then I kind of move on, or if it looks great, I'll focus deeper into it.
Right. And one caution I would have for people is, sometimes it's very easy to kind of do a study and you look at kind of the aggregate and say, oh, you know what? It looks like this rule does much, much better, but sometimes you have to dig a little bit deeper into those instances. You can
Right.
sometimes have those outliers that are skewing, and, I mean, not to get too much into the statistics, but it is important to kind of understand when you're applying something, what it actually did. And so looking
Well,
at some examples.
one thing I always do when I do a study as well is I go back and I look at the best stocks. And so
Yeah.
I think the two biggest mistakes you can make is, one, you take a very big loss on the downside, which typically, if you cut your losses, should not be a concern.
Right.
The second largest mistake is missing out on a huge winner. So, I don't care how effective some kind of new tool or approach that I'm working on can be. If I look at a year like last year, and this would have prevented me from having some of these huge winners, well, that to me is a critical error in the approach. So that's why I always take whatever I'm working on. I have a list of, all the past winners going back 20, 30 years, and I'll go one by one. If I say, oh no, this would have really prevented me from catching a major move, I say that's a critical error, and I'll put it aside, or I'll try and adjust for it.
Yeah. So now let's kind of shift gears a little bit and talk about, beyond relative strength. There's these shades of gray. And so sometimes,
Mhm.
when you're looking at, oh, you know what, if you want the best stocks, they tend to have the earnings growth of, let's say 25% in the current quarter, or 25% annual growth for 3 to 5 years. But then you find sometimes that there are some of these rules that it's okay to break them, right? There's
Right.
people always had all these exceptions to the rules. So how do you use kind of your rules? Which ones are, hey, this is black and white, I always follow, and these are the ones where there's a lot of exceptions and I might do something a little different?
So what I like to do is I kind of have non-negotiable rules. So for example, in terms of earnings and sales, or actually earnings is actually a negotiable for me. What I like to look at is I like to look at the company. Is this a company that is being bought based on sales growth or earnings growth? It's usually pretty easy to tell because, for example, software companies have stellar, sales growth, but often are lacking in earnings. So, there has to be that strong revenue component. But a stock that's already sporting earnings, I want to see big earnings numbers, big sales numbers, and I want to see record earnings and record sales, or at least a multi-year high. So, for example, the energy names, there was so many you could have chosen from. When I was on the podcast last time, I was talking about Denbury. They had reorganized and they were
Oh,
sporting record earnings already.
yeah.
Whereas so many other energy stocks were just trying to get back to some recent years earnings. So why not go with the stock with the absolute best?
Mhm.
And that goes back to the founding principles of growth investing is you want to find something that's new, that is growing. So if by definition, if this stock is not making record highs in sales or earnings, they're not really growing. So, and that I really believe is what causes these massive moves, like William O'Neill obviously wrote about. And so those are the non-negotiables. Then there's things like return on equity and all these other components, up down volume ratios. That's where the shades of gray come in. And I like to have some shades of gray in my work because for years, I was a market maker and I day traded, and I like the feeling of making decisions. I don't like it to be completely robotic. I think maybe makes it too boring or takes the fun out of it. But I have those non-negotiables to keep me in the right direction so I can't make any critical errors. And then I use my experience to really dial in to find the stocks that work best with my understanding in terms of the technical picture and the growth behind the company. So that's the way I like to kind of build a mosaic of putting all the data together and working within the framework of those variables that have to be there.
Yeah, so I really like that kind of picture of the mosaic. It's not just one thing. You're putting together a lot of different pieces of the puzzle here in order to get that complete picture.
Well, you want to boil it down. At the end of the day, what are we all trying to do here? So you're trying to find a stock that's growing aggressively, that has a long runway, that will keep growing. And you want to buy that stock at a point where your risk is controlled and your upside is very large. So you want to build a picture to capture that. I think sometimes we get so caught in the weeds of all these indicators and numbers and variables. And so what's, if you boil it down to its essence, what are you trying to do? And that's what I always, every time I'm looking at a stock, oftentimes it could be a stock with great earnings or great sales, or a good looking chart. You want to boil it down. Does it check off the idea that, is this a growth stock with a long runway? Do I have a controlled risk with good upside when I'm purchasing the stock? That's the key essence of what we're trying to do.
Yeah, great point. So when we come back, we're going to get into some of the ideas that Matt has on his radar. So make sure you stay tuned for that. We'll be right back. Do you feel like you're always late to the best trades? You don't have to kick yourself for those missed opportunities any longer. Today is your day. Vantage Point's artificial intelligence has helped traders of all experience levels with its predictive analysis forecasting. Visit www.freestockcoaching.com and find out how their AI automatically recognizes global market patterns well ahead of the news to help you pick the best trade. Go to www.freestockcoaching.com to join a free live training session today. Vantage Point's patented artificial intelligence can give you a massive edge. Don't hesitate, save your seat now. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to Investing with IBD, sponsored by Vantage Point. I'm Justin Nielsen, and we have our guest, Matt Caruso. And now, Matt, you were talking a lot about these, the post-analysis, all of these things that you've learned, and you've got something coming up that's pretty exciting. You've got Caruso Insights to kind of share some of this education, which you have a background a little bit in education.
Right. So when I first started trading professionally, I actually was also an adjunct finance professor here in Montreal, and I really enjoyed the teaching aspect of it. But trading gets so busy, I couldn't continue going with that. But I decided to start. I noticed there was the modern way of learning now is video courses, and I thought it was a great time to build something where I can go through the entire trading strategy that I employ in a video format that's easy to understand. I think information overload is so difficult with so many books out there and different methods and methodologies that I want to really bring one place where, from mindset to position sizing to when to buy, sell, and portfolio rules, to really walk someone through the way I approach the market. So I'm an aggressive trader. I'm an aggressive investor looking for big returns, but with controlled risk. And, I love William O'Neill's book. It's the foundation of what I use, but just through my own experience, there's a lot of gray areas in there that took me years to kind of patch together. And also my experience as a day trader, market maker, sometimes, I would see people buying breakouts that are textbook, but as a short-term trader, I'd be probably fading those or selling those.
Right.
So I took a lot of the short-term techniques that I use to incorporate within a larger term strategy to kind of create this holistic way of investing. So I'm working on that. Hope to have it out next month. And it's an exciting new product I'm working on.
Yeah, well, I'm going to be looking forward to checking that out myself. So let's get into some of the ideas that you've kind of called here. Are there any particular themes that you've noticed, or is it really kind of a mishmash of individual stocks that you've been noticing that seem to be working, just that whole risk on?
It seems really risk on, especially what I like as a good signal. I didn't catch many of them because they were just rockets higher, but a lot of the recent IPOs such as TSP or ASAN, GLBE, just rocket ships higher. And that's typically, it's like GLBE IPO'd and was just from day one a rocket ship higher. So that's a real vote of confidence in the marketplace that there's risk on that's taking place. And, these IPOs tend to be a little more volatile and they're kind of difficult to handle without an IPO base. So, I mean, sometimes I take that as a signal to say like, okay, risk on is coming back into the market. Now let's find these great other risk reward opportunities, maybe in stocks with proper bases or well-defined risk areas. One of the beautiful things about Roku, like I was speaking about before, is if you look at the fundamentals, I mean, we're talking record earnings in 2021, actually first year of positive earnings. 2022 is showing huge growth coming through again. And I think Alyssa recently had an interview with the CFO of Roku, and the story behind it is fantastic. I remember when one of the first monsters I caught was Netflix, and it was a very similar view of that company as Roku, and there is a link between them as well. But I remember no one believed in that story. Oh, Comcast is going to launch their own product, and they won't renew the contractual the contract with Netflix. And Roku has kind of had that same disbelief in the company, whereas, it's just a stick that you plug in that people can watch stuff on. But if you really dig into the story, they built the operating system for the TV, and the amount of ad dollars that are flowing to streaming is just huge. And if Roku can become the dominant player there, which I think they could be, because I think that the closest competitor is Amazon with the Fire Stick. But the problem with Amazon is a lot of content producers view them as a competitor because they also do content production. So Roku is in this beautiful middle ground where they're getting all these people coming to their operating system, and they get the ad dollars. And I think it's just a great business model. I think it's still not fully appreciated. And if you look here, I know this has it as a cup forming, but I saw more of a double bottom that we broke out of the past few days. So that's the way I'm approaching it. And if you flip over to, actually first on the weekly chart here, the low of the base, you saw kind of a huge pickup in volume, but that was pretty supportive action.
Yeah.
And the week after was also huge volume, and we didn't go any lower. So, in my perspective, that's, a big buyer stepped in and said, whatever stock you want to sell, I'm here to take it. And that kind of marked the low. And with some recent good news, I think we're starting to work strong on the right side of the space.
Yeah, so just so people can kind of get a picture of this in their mind if they're listening to the audio, the week that he's talking about is this low, and it closed in the 60% range. Whenever something closes in the 40% range or higher, we usually talk about that as being supporting action, especially when it's a really wide week. You see that a lot of price discovery between the high and low of that week, with the close in that upper part of the range. And then, as you mentioned, the very next week, heavy volume without further price progress on the downside. It all was maintained within that previous week, so an inside week, and closing not just in the upper part, but actually in like the 80% range for the trading week. So yeah, really good nuances there in terms of, it's not just about, oh, look at that heavy volume on the downside. It's, you got to look at the price action and see, was that truly positive price action, even though the volume is red.
That's when you kind of get beyond the charts, and you really want to understand what's the demand and supply. What is the chart saying about demand and supply? So those nuances, they seem like nuances, but that's the difference between someone just drawing a line on a chart and someone really trying to understand what's going on between buyers and sellers. And that's really the main goal of why we use charts in the first place.
So this week we're halfway through, and it's already up almost 15% for the week. Is that something where you feel like this maybe needs to tack on a handle to the double bottom? Or is it something that, look, the breakout is happening right here around 400, round number. This is something that is still actionable potentially?
I think it depends your level of risk. What I do like is that the volume has been, huge. We're midway in the week and we're already at average volume. So there's significant buying. Personally, I want to own more of the stock than what I already own. So, I'm kind of hoping it does pull back a little bit. But if sometimes I think it's a little extended, but I see that there's something really bullish going on, I'll maybe buy a little less than I usually buy and wait for a consolidation or a pullback. So again, depending on the person's risk level and their approach, I don't think it's so far extended that it's not viable. But I know myself, if I can get a pullback to the 400 level where that double bottom breakout happened, I'll be looking to add more exposure.
Yeah, and that's a good point. Sometimes just buying a little bit, there's nothing like having some skin in the game to draw your attention to something. And so if it does do what you're expecting, it kind of follows along with your expectations, you can kind of start building your position a little bit more. Or if it does kind of start getting away from you, it's a little bit different if you're adding a little bit to the position when you have some low average cost stock already. It helps a little bit so that you're not starting out with it necessarily too high.
Yeah, it completely changes your mindset. So I think that's really key.
Okay, let's take a look at another one. So NTRA. Or was there anything on the daily that you wanted to look at on a Roku?
I think the weekly spoke pretty well as
Yeah.
to what's going on. Yeah.
Okay, so here's NTRA, and I got to say that the medical area just seems like an area that is getting a lot more attention with
Right.
the reopening. Maybe there's some procedures that have been kind of put on the back burner, and maybe some of those are happening. But tell us what you like about NTRA, Natera.
So one thing I like about Natera, again, talking about the non-negotiables I mentioned before, this is really a sales-driven story. But if you look, we're having record sales this quarter, and actually we have three to four quarters of accelerating sales, each quarter. So that's really, the business is really picking up. And the way I view the chart here is basically, I think it's kind of like a base on base, or kind of like doing a cup with handle after it did an initial deep cup. It's a little bit strange on the weekly, but I think it's a little prettier on the daily. But Natera, I mean, their background, their business is fantastic. I mean, my family, I have two young boys. My sisters all had children recently, and everyone I know who's had children recently is getting these genetic tests, to check for potential issues with the child, et cetera. And they're one of the leaders in that space. They've also expanded to oncology for more precise chemotherapy pattern usage. They're also working with companies developing drugs where they can do genetic testing to see which patients would work best with the medication that they're developing. So there's kind of a lot of pipelines, and interesting pipelines with huge addressable markets. So when you tie that story in together with accelerating sales and what I see as a kind of a base on base with a cup and handle. And if you look at the past few days, we've had some great volume on the daily chart as some good news came out in terms of one of their products. I think you can see that there. So I think this has a lot of potential to be a leader. Another stock in the space, Invitae, seems to be lagging. This seems to be the stronger of the two.
So now you mentioned that you're kind of looking at this as more of a base on base rather than the double bottom pattern that we were talking about with Roku. And I guess one of the key elements there with our double bottom pattern that we like to see is that second leg undercut the first leg. And that's not something that we see here in Natera. It just fell short. But here again, I think it is interesting that if you do look at the weekly action and that volume, you see that we've got that little orange balloon showing you that it's the heaviest volume in the base there, and that's another example of that supporting action. You've got the heaviest volume. It came down. What was it? 7.5% the week before. The next week it only came down. It came down 8%. It looks like, is that right? Yeah, 8.5%. But where it closed at was very high in the range. So it did seem like it was trying to resist it, and that got it right back above the 40-week moving average line, kind of dipped below it and then right back above it.
Yeah, and the fact that it's back above its averages, I won't trade anything below the 200-day. I won't even look at it. It's off my scans. So the fact that it got back above the 50-day moving average, it paused, and now we're breaking higher with volume. I really like the look of the chart. I like the story. Really gets me excited is how sales have been accelerating for 3 quarters in a row. So that usually is showing that the business is really picking up steam.
Yeah. So I mean, you just look at these numbers. So starting in June 2020, you had 16%, then 26%, 35%, 62%. So again, that acceleration, quarter after quarter is something that you don't want to ignore when you see that either on the revenue side or the earnings side. So let's go ahead and wrap this up. We got one more stock to cover. That is FRHC.
So this stock here is interesting. Most people ignore it. It's based in Kazakhstan. So I think that usually turns off most people. But the reason, that's why I like to deep dive into companies. Years ago when I was focused more in the commodity space, the big Canadian uranium producer, Cameco, I think you spoke about that recently on the show.
Yeah, CCJ.
Yeah, right. They have a lot of mines with Kazatomprom because, Kazakhstan is one of the probably the world's largest uranium producer. And so when I used to,
Canada's up there too.
Sorry. Yeah.
Yeah. Canada's pretty high on the uranium, but you're right. Kazakhstan is definitely a leader in that.
But I remember looking into, Kazakhstan and the leader of that country really took on the Singapore model, and they want to become kind of this free market capitalist state within its region and a leader in that. So they're really trying to open up. Freedom Holding, they're basically in the brokerage business, which is also getting tailwinds similar to, the Robinhood app, et cetera. And they have mind-blowing earnings and sales growth. So obviously the market cap at $3 billion is smaller. There's a bit of geopolitical risk. But this chart, if it reminds me, if anyone wants to look back, I know William O'Neill showed the example of Price Club when he first bought it.
Right.
And it was kind of like week after week in a straight line up, just like this was on its first move higher. And I remember him saying that, he was waiting for its first base and then a double bottom formed. And, finally, just the same thing here. I was watching this take off. I said, oh, I know that Kazakhstan is privatizing, so I should have maybe had an eye on this despite the low market cap. And here we are with a nice double bottom, huge volume on the upside, massive earnings and sales. Again, maybe you want to adjust for your position size if geopolitical risk bothers you. But I mean, in terms of the rest of the technicals and fundamentals, it's pretty stellar in my opinion.
Mm-hmm. Do you ever say, okay, I'm gonna correct for that extra volatility by giving the stock more room, maybe making my loss, allow for a larger loss potential, or where your stop is, or is it just about position size? How is it that you mitigate that risk?
I make a position size because for years when I started out and I was a market maker, our main space was the mining space. So overnight there was always that risk that a mine could flood or a grade can come in lower than expected and the mine has less gold than you thought, and the country takes over, nationalizes the mine. So overnight, I mean, whether your stop is tight or not, overnight that doesn't matter anymore. So if ever there's something like that does bug me, I'll adjust by just reducing my size so that if something catastrophic happens, it'll be on a smaller part of the portfolio. But sometimes these have, great upside, so it's worth having some exposure to them. But again, it's kind of a personal decision as to how much you want to position size. I think lowering your exposure is really the best way to reduce your risk.
Excellent. So, hey, Matt, I got to say, I really appreciate you coming back on the show. This has been a lot of fun. So I'm sure this is something we can do again, especially after your Caruso Insights comes out. So looking forward to seeing that education when it becomes available. So thanks again for being on the show.
Absolutely. Thanks so much for having me. It was a real pleasure.
Okay. So next week, Jim Golan, who is a partner at William Blair, he's going to be on the show. He's also a CFA. So make sure to tune in for that. That's it for this week for Investing with IBD. I'm Justin Nielsen. Thanks for listening, and we'll see you next week. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.